Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Hans Lee, and in this series we're going to be discussing alternative investment strategies. But rather than analyze each strategy one by one, we're going to find out how each of these strategies and which strategies work best in different environments. And our guest to walk us through all of that is David Elms, Head of Diversified Alternatives at Janus Henderson. Welcome, David.
Thanks, Hans. Thanks for having me on.
Pleasure. And why don't we just start at the top, start with these big picture questions that all investors get. What probabilities are you putting on a soft landing, a benign environment, a Goldilocks outcome, and maybe what probability are you putting on a hard landing or a more recessionary type scenario?
It's a good question, and I guess before answering the question on its own terms, the strategy that I run for our investors is not a strategy that tries to explicitly take large macro views. So we want to build something that's robust to a hard landing, robust to a soft landing. And we do that by the way that we blend strategies together and the way that in particular we use optionality and protection in our strategies. But if I answer your question, I would be tilting towards a harder landing than I believe is priced in current consensus.
All right, well, we'll come back to that, I'm sure. Reading through your documentation, I thought one thing that was interesting was that you talk about investing in strategies at a bottom-up level, but with a top-down protection strategy. So please, for the benefit of everybody, explain in as simple terms as possible what that means.
We run 7 different strategies. We call 6 of them risk-on strategies, and that doesn't mean that they only work in bull markets. They're individually hedged to produce profiles that are positive in up, flat, and down markets. But the problem is what happens in a crisis? What happens if COVID comes back? What happens if the world starts to move the way it looked it was going to move on August the 5th when you had the big sell-off in Japan? And for that sort of environment, we have a 7th strategy, and the 7th strategy provides air cover for the first 6. It's called protection, and it's designed to sit unobtrusively in the background in normal environments, but appear and make strong returns in a crisis where the other strategies tend to struggle regardless of being individually market neutral. So bottom-up risk-taking in the first 6 strategy, protection, providing air cover on a top-down basis for the other 6.
Okay, so when you talk about protection, I guess most people think about using options, or maybe if they don't have access to that, just having a lot of cash maybe on the sidelines. What does protection look like to you? What different instruments do you have at your disposal to do that?
So we run 3 different strategies, and the strategies each use a range of instruments. The 3 strategies we run are trend following. So sometimes you can slide gradually into a crisis and it starts to be reflected in prices, and a trend following strategy adapts based on the direction of prices. That's the first strategy. Second strategy, systematic long volatility. You mentioned options, and SLV, the volatility strategy, uses options so that you always have something in the portfolio that if a crisis happens quickly, if a plane flies into a building like it did in 2001, or you have an earthquake in Japan like 2011, even COVID in 2020 came pretty quickly from a financial markets perspective. You can't rely on a signal being there in prices. You need to have the protection in place, in situ, ready to go as the crisis unfolds. So they're the first 2 strategies. The third strategy, discretionary macro, so that's judgment-driven macro with long convexity. So again, setting up option trades that have limited downside and as much as possible uncapped upside to benefit from views that are non-consensus in their setup.
You've mentioned August a couple of times. I think that's curious because apart from then, most of this year we haven't seen the VIX really move above that 20 level. It's been relatively benign. Volatility's actually been very low generally. So how do you and the Janus Henderson team approach portfolio construction during periods of ultra-low volatility when it seems like nothing is happening underneath the surface?
I mean, I mentioned August because it's really unusual. If you look at a 20-year history of the VIX, there's 3 big spikes. So October 2008, the GFC. If you say October 08, that's normally enough for people. March 2020, COVID, that's enough. People know what happened. People know volatility went up in both those environments. But the third big spike, if you look on a chart, is now August 2024. And there's no really good reason for it. There's a bit of an accident in the volatility markets, and if you were quick, you could monetize that effect, but it didn't spill over. So the reason we've been talking about August is that it's still live, so it's possible that things can still emerge in the last week or so of August, but also because it's unusual. Volatility went up fast for no good reason, and when the market realized it was a bit of a head fake, it came down fast as well. So you had to be quick to monetize, to take your profits, and it required nimble thinking. And the good thing about running multi-strategy is that we can be nimble. We have all the levers at our control. We're not allocating to different funds. Everything operates in the portfolio.
In periods like the ones we're trying to get at, this benign environment, do you tend to find that you're gravitating towards more of, specific of those risk-on strategies, or do you find it's a relatively equal weighting across multiple strategies, and then when things happen, you're putting things into action?
So if we look at the long run across the risk-taking strategies that we have, we end up being pretty equally weighted. And that's good. That's diversification. You should be diversified in the ways that we take risk in a portfolio. But if we look at any particular point in time, we're not equally weighted. At any particular point in time, there'll be a strategy with better prospects, with more activity, with more mispricing. And what we tend to do is concentrate risk more, not over-concentrate it, not run a completely undiversified strategy, but tilt more to the best opportunities at any point in time.
Perfect. David Elms of Janus Henderson, thank you very much. And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more episodes of The Pitch. We'll see you next time.